There's a clock ticking. You can't hear it, you can't see it, but it's counting down to the moment when your opportunity to buy silver ends forever. Not because silver disappears, not because it crashes or fails, but because every single day, every single hour, physical silver is being pulled off the market by industrial demand, long-term investors, and institutions that will never sell it back at these prices. While you're reading this, while you're thinking about whether now is the right time, while you're waiting for a dip or more certainty or the perfect entry point, the available supply is vanishing. And here's what terrifies me about this. People think they have time. They think silver will always be there, always available, always accessible at some price. They think they can wait a year, 2 years, 5 years and still get positioned. They're catastrophically wrong. The window isn't measured in years. It's measured in cycles, in quarters, in the amount of time it takes for structural demand to absorb what is left of the tradable supply. And that time is far shorter than anyone realizes. You don't have a decade to decide. You probably don't have 5 years. You might not even have 2. The clock is ticking down to zero. And when it hits zero, when the available silver is gone, you don't get another chance at these levels. Let me show you exactly what you're missing, why time matters more than price, and why waiting is the most dangerous financial decision you can make right now. Let me start with a reality that should shock you. Silver is not like Bitcoin. Silver is a real-world material. It gets consumed, it gets used, it gets turned into things you can't recycle efficiently, and that makes the supply dynamics even more brutal than people understand. Every single year, the world produces roughly the same amount of silver. Mining supply doesn't suddenly double because the price goes up a little. New mines take years, permits take years, infrastructure takes years, but demand can surge fast, and it already is. And here's the part no one is paying attention to. Industrial demand for silver is exploding. Solar panels, EVs, data centers, semiconductors, military tech, the electrification of everything. Silver is one of the most conductive elements on Earth, and the modern world is becoming more electric and more connected every single year. That's a one-way trend. So you have a situation where new supply is slow, fixed, and fragile, but demand is accelerating. That's a mismatch. That's a deficit waiting to become visible. Now, here's what people miss about silver supply dynamics. They hear there's plenty of silver in the world and they assume it is always available. They look at the current price and think they can buy any time. They don't understand the difference between total silver and available silver. The silver that matters is the silver that's actually accessible to buy, the silver sitting in vaults, the silver in investment bars and coins, the silver that can be delivered into the market, and that liquid supply is a fraction of what people imagine. Because a massive portion of global silver production gets consumed by industry and disappears into products that are never economically recycled, another huge portion sits in long-term hands, and what's left is a relatively thin layer that trades. And that thin layer can be drained shockingly fast once demand flips. Think about it like a reservoir. Silver flows in slowly through mining supply. Silver flows out through industrial usage and long-term accumulation. For years, the market stayed balanced because demand grew at a manageable pace. But we've crossed the threshold. Outflow is becoming bigger than inflow, the reservoir is draining, and the rate of drainage is accelerating. Now ask yourself, what happens when the reservoir runs low? When there's not enough deliverable silver to meet demand? Price discovery breaks, premiums explode, the paper market disconnects from the physical market, buyers start bidding against each other for real metal, and silver doesn't move gradually when this happens. Silver goes vertical. Retail investors, the regular people who were waiting for the perfect moment, get completely priced out. Not because silver is too expensive, but because the market simply can't deliver enough supply at the old price. Now let me explain why waiting for dips is a fundamentally flawed strategy in this environment. People think silver will behave the way it always has, that it will stay boring, that it will chop sideways, that it will frustrate everyone and do nothing while other assets run. And yes, silver has done that for long periods, but that's exactly why this move can shock people, because silver is not priced like a critical asset, it's priced like an afterthought. And when the market finally reprices it, it does it fast. Here's the old retail playbook. I'll wait for silver to drop. I'll wait for more certainty. I'll buy when it breaks out. But the problem is that once silver breaks out, the breakout doesn't look clean. It looks violent, because silver is a small market, it's thin, it's emotional, it's leveraged, and when money finally floods into it, there isn't enough supply sitting there waiting. This is why silver's rallies historically aren't slow climbs, they're spikes. Now let me show you what actually happens. While you're waiting, you see silver at $25 and you think, I'll wait for 22. Smart plan, right? But while you're waiting, demand keeps building, industrial usage keeps rising, inventories quietly shrink. premiums rise, and silver doesn't drop to $22. It goes to $28. Now you say, okay, I'll wait for it to pull back to 25, but it doesn't. It goes to $30, and suddenly silver is in the news. Suddenly influencers are talking about it. Suddenly people who ignored it for years start paying attention, and now you're not buying early. You're chasing late. And even worse, even if you get your pullback, even if silver drops from $30 to $27, you're not better off than if you bought at 25 originally, because now the market environment has changed, more inventory is gone, more metal is locked up, the cheap supply is shrinking in the background. Your entry price might look similar, but your opportunity to accumulate meaningful amounts has shrunk. That's the game you're trying to play, timing perfection, and it doesn't work when supply is tightening and demand is structural. Now, let me explain the institutional and industrial playbook that retail doesn't see. Big money accumulates during boredom, not during hype. When silver is quiet, when nobody cares, when it's been dead money for months, that's when long-term buyers build positions. Why? Because that's when the market has supply. That's when prices are stable. That's when they can buy size without triggering panic. Then the moment the hype begins, the easy buying phase is already over. This creates a cycle that retail misreads completely. Retail thinks, nothing is happening, silver is boring, I'll wait. Smart money thinks, perfect, this is where you position before the squeeze. Retail waits, smart money accumulates, then the supply shock hits, price runs, retail FOMOs in at higher prices, and the cycle repeats. Now let me make this concrete with a timeline. Right now we're in the phase where the macro backdrop is shifting. The world is loaded with debt. The monetary system is fragile. Governments keep needing liquidity, and hard assets matter more than ever. At the same time, silver demand from electrification is accelerating. Solar alone is a massive driver, and AI infrastructure is a growing driver, and none of this is slowing down. So what happens over the next 12 to 24 months? If investment demand rises even slightly while industrial demand remains strong, the available inventory gets squeezed, the market starts to feel tight, premiums rise, delivery times increase, then the price starts moving, and once it moves, it attracts attention, and once it attracts attention, it attracts capital. And because silver is small, that capital has an outsized effect. That's why the window you think you have is not real. You don't have 5 years. You might not even have 2. You have months to position before this becomes obvious. Here's the psychological trap people fall into. They see silver's price and they think that's the main variable. They focus on whether it's going up or down, whether they're buying at a good price or a bad price. But price is not the main variable. Access is the variable. You can buy silver at $25 and it drops to $22. You feel bad temporarily, but you own the asset. You have exposure, you're positioned, and you can accumulate more. But if you wait, if you don't buy because you're trying to optimize price, and then the market tightens and the premiums explode and supply disappears, then price becomes irrelevant. Silver could dip on paper and it wouldn't matter because real metal would be unavailable or only available at massive premiums. That's the scenario people aren't considering. They're so focused on price optimization that they're ignoring supply disappearance, and supply disappearance is the real risk, the permanent risk. The risk you can't recover from. Let me explain what physical scarcity really looks like. When demand exceeds supply, you don't just get higher prices, you get distortions, you get shortages, you get delivery delays, you get premiums that detach from spot price, and the people who own the real thing are the people who win, because they're holding something the market can't produce fast enough. Now, let me address the people who think silver is old news. They think it already had its moment. They think it's outdated. They think it will never outperform modern assets. But that's exactly why the upside exists, because silver is underowned, underloved, underpositioned, and the moment it becomes fashionable again, it won't gently rise, it will shock people. Here's the truth about cycles that people misunderstand. The best opportunities are not the ones everyone is talking about. They are the ones everyone is ignoring right before they reprice, and silver is one of the most ignored assets on the planet relative to how important it is to the future economy. That's why the move can be so big, and that's why the window is so small. Let me tell you what happens to people who realize too late. I've seen this pattern in every major transition. Most people don't recognize the opportunity while it's available. They dismiss it, they wait, they want more proof, and by the time the proof is overwhelming, by the time everyone agrees it's a good idea, the opportunity is gone. The early buyers accumulate cheap, the late buyers chase expensive, and the ones who wait too long don't buy at all. Because they mentally freeze when it's moving, and then comes the regret, knowing you had the chance, knowing you saw the information, but you didn't act. Now here's what I need you to understand. This isn't about creating panic. This isn't about forcing you to buy silver. This is about recognizing reality. The reality of a critical asset with constrained supply meeting accelerating industrial demand and eventual investment demand. The reality that this doesn't play out over decades. It plays out over months and quarters. You have less time than you think. The clock is ticking faster than the market realizes. And when time runs out, when inventories tighten, when the physical market gets stressed, the opportunity at these levels is gone. You can't go back. You can't buy what isn't available. You're just locked out while watching the price reprice upward because the world needs silver and the supply can't keep up. The question isn't whether silver will be higher in 5 years. The question is whether you will have a chance to buy it calmly before the market wakes up. And the answer is probably no, not at these levels, not without chasing. The window is closing right now, and you either recognize that and act, or you wait and regret. Those are the only two options. Choose carefully, because the clock doesn't stop, it just runs out. Now let's get back to silver.